I am joined now by today's closing bell ringer, Ron Santella, CEO and founder of Equable Shares. Welcome to the New York Stock Exchange.
Ashley, thanks for having me. It's a pleasure to be here today.
All right, so this was your first time ringing the closing bell, your company. What did that moment feel like for you?
Felt great for a couple reasons. My twin brothers rung it twice, so now I can say I rang it at least once. But having your own company and your own ETF and ringing the bell is just special. And there's no place that we'd rather be than the New York Stock Exchange. It's iconic, the history here. So yeah, just tremendous feeling to have my whole team here and 40 guests today.
Can you tell us about your firm and tell us about this ETF offering? I realize it's a first for you.
Sure. So the firm's 8 years old. We're based in Naples, Florida. We specialize in hedge strategy. We've done a fair amount of customized hedging for individuals. The ETF is our flagship product, HEDG, hedge. It's a hedged equity product in the S&P 500, about 6.5 years old. But we converted from a mutual fund to an ETF in October this year. So hence the new launch of the ETF.
Why did you convert from a mutual fund to an ETF?
I think we just identified that it's been a secular trend now for a couple decades that ETFs have continued to take share away from some actively managed strategies. As you know, there's over $14 trillion now in the ETF space. And the last couple of years, I think that momentum has picked up, and it just seemed like it was the right move for our investors. And it was really just a client-centric decision on our part.
Who is the target investor for hedge?
I like to draw an analogy to anybody who owns a house and has insurance. Like if you own a home, you have homeowners insurance. Our product, or a product like ours, should be in everybody's portfolio. We're going to perform reasonably well in up markets. We've annualized at double digits over the last 3 years. But when the market's flat or when the market goes down, you're going to sleep better at night. So for me, the target audience is anybody who wants exposure to the S&P 500, albeit at less risk and a lower volatility.
What are you focusing on? Is it mostly large caps? Is it S&P 500 stocks?
Yeah, so we're a beta play in the market. We own 2 ETFs, SPY and IVV. We want it to be a pure play on the market. We're not stock pickers. And then we're doing a systematic hedging program around that every 90 days to reduce the risk of the underlying market.
And how does hedge fit into the current market environment?
You know, I like to think that it's an all-weather fund, and so whether the market's been up or down, hedge has done well. But I think currently, you know, we're coming at the end of 3 years of strong performance in the market. We've had 2 years over 20%. The market's up about 17.5 through Friday of last week. I think as we go into 26, some people are just thinking about how do they get a little more defensive or lower volatility. So we're seeing more interest in our product.
All right, what is next for your firm?
One is just to get focused on hedge. We've grown 20% since we listed the product on October 13th. So in 2 months, we've grown quite a bit. Number two, we expect to roll another ETF out sometime in 2026. That's similar to hedge, but maybe on another index.
All right, Ron Santella, CEO and founder of Equable Shares. Thank you so much for joining us at the New York Stock Exchange, and congratulations on ringing that bell.
Thank you, Ashley. Thank you for having me.